Hi, it's Barry Parker here, and I want to welcome everybody back to Capital Link's Trending News podcast series. So today we have with us Dr. Loucas Barmparis, who's the president and a member of SafeBulkers board of directors since 2008. So SafeBulkers, I think people know, but just to review, it specializes in the ownership of dry bulk vessels. So as of the beginning of August, SafeBulkers had a fleet of 43 dry bulk vessels. They're Panamax, Kamsarmax, Post-Panamax, and Capesize vessels. It's worth reminding everybody that 85% of the fleet has been built in Japanese yards. Company also has a new building order book, and it's 9 vessels at this time. 7 of those are Kamsarmaxes, 2 of them are Post-Panamaxes, and the deliveries are scheduled from first quarter of next year, so first quarter of 2023 through the first quarter of 2025. So we're going to talk today about the outlook for the dry bulk sector, but we're going to focus predominantly on the company's fleet renewal strategy. And we're going to talk which seeks to match sustainability, profitability, and competitiveness over the long term. So let's start. So just briefly on the dry bulk sector overall, I wonder if you could talk about, Loucas, what the fundamental drivers are and what are your expectations? We're in the second half of the year, so what are your expectations for the second half of 2022 for the sector?
The expectations for the dry bulk market depends on 2 factors. The one is the supply of vessels, and the second is the demand. The demand may be influenced by the global conditions and what will be the reactions in relation to geopolitical situations, invasions of Russia or in Ukraine, etc., etc. So we have somehow an instability from that part. However, the fact that the supply, or there is no oversupply of vessels in the next 2 to 3 years for dry bulk cargo gives us some reassurance to us that there are good prospects in the dry bulk chartering market. And we say so because most of the orders were placed in several shipyards for tankers and container ships. And if you want to go today and make an order in any Japanese or Chinese shipyard, you will not receive anything earlier than the second half of 2025. So basically, we know that the order book for the next 2 to 3 years is what it is today. So this gives us let's say the feeling that one way or the other, the chartering market will do well in the dry bulk sector.
And I think there's some statistic about the order book. It's 5 or 6% that's of the fleet, and that's a historical low. It's my understanding.
Historical low, and something that we need to focus also is that the fact that this 5 or 6% of the global fleet will have, let's say, newer specifications. But imagine that we have a whole fleet out there, which almost about 75 to 80% is not compatible with the new regulations. They are not, all these vessels do not belong to any greenhouse gas phase, IMO phase 1 or 2 or 3. So the new vessels that will be delivered will have advantage compared to the existing fleet.
Oh, that's a good segue actually into the next group of questions, which have to do with the fleet renewal and expansion. You followed a strategy of you've sold older vessels and you contracted for the new builds, and that's a means of ensuring the long-term competitiveness for the company. And it's interesting to note, I think you're one of the few companies that's really involved in an aggressive kind of a new build campaign. So I wonder if you talk about the rationale for that, and just elaborate a little bit more on the environmental regulations. You started to talk about that and what that means for the competitiveness and the profitability of the company.
Yes, we started quite early, before 2020. I mean, we had started discussing internally about orders, and we have done in total about 11 new build orders of phase 3 vessels, which at that point did not exist basically. Only 1 or 2 shipyards were able to deliver such vessels. And we'll explain what this means. And so we have this advantage that we placed all of these orders below the market. So on average, you may say that it's a low 30s, the cost per vessel, while maybe if you want to make an order which will be delivered after 2025, it will be about 40. And the second point is that we have already taken delivery of 2 vessels, and next year we're taking 5, 6 vessels more, and all these deliveries are concluded within 2024. So this gives us a substantial advantage, because basically we will 25% of our fleet will consist of phase 3 vessels. Now, what is the meaning of this phase 3 vessel? IMO has put some regulations, and these are called phases: phase 1, phase 2, phase 3, representing a 10, 20, and 30% respectively CO2 reduction, design CO2 reduction, compared to the level which was at 2008. So these phase 3 vessels have a substantial lower CO2 emissions, which corresponds, of course, to substantial lower fuel consumption. And you understand what we mean today, having lower fuel consumption. And I will tell you an example. I mean, one of the newest vessels, which is named MV Vasos, has a consumption of about 14 tons per day of fuel per day at 12.5 knots, while most ships have more than 18.
Mm-hmm.
Many of them have, let's say, 19, 20, etc. So you understand that this gives us a substantial advantage when you have, let's say, about more than 4 tons compared to the market. And this is paid to us directly as charter hire, because the charter sees the overall cost, the cost of the chartering plus the cost of the fuel. So this is a big advantage. And right now we have already taken delivery of 2 ships out of this 11. So we did this strategy to do all this ordering at a very early stage. No one followed us, and basically on the assumption that we don't know exactly what will be the new fuel that will prevail. I mean, it will be ammonia, methanol, hydrogen. And I mean, our response, we had adopted a very pragmatic approach, because we thought that there is no new fuel right now. I mean, whatever we discuss, it will be maybe the first vessel that will be designed, it will be for 2026, 2027, 8, or so on. And there will be no designs available to us. And even if you have such designs, it will take a longer period for more yards to adapt such designs, and longer period to create the fuel network systems that you need to supply such vessels. So we're discussing about 10 to 15 years later compared to today. And so, I mean, our decision was to renew the fleet with a pragmatic approach, that we take 10 vessels now, 11 vessels now, and not ships in 2030 or so with new fuels, which we don't know exactly what will prevail. So I think this will give a big advantage to safe bulkers in the following, I mean, starting from the 1st of January 2023, because the regulations start from that point.
Yep, and that's when you have the vessel deliveries starting.
Yeah,
so let me.
And we continue next year with 6, I think, or 6 or 7.
Yeah.
So when we did that, I will tell you also the last part and the last part of the rationale. So when we did that, we thought, okay, why don't we sell older vessels? So we sold some older vessels of 2003 and 4, which was the right thing to move. And basically, we sold the heavier, the more consuming vessels. Then we realized that the market is quite good. So from time to time, we found an opportunity to buy a younger vessel. So we sold at a high market an older vessel, and we bought for a little bit more a younger vessel, let's say 10 years younger. So overall, the fleet didn't lose the ability, the earning capability that we had. We sold several new build vessels while we are waiting for the new builds to come to our books.
Let me ask you one thing before we move on, because I have a chance to clarify. When you read about the regulations, there's the regulation coming in called EEDI. So that's the phase 3 that you're talking about. Is that right? Is that the same?
The energy efficiency design, it's not exactly this one. The energy efficiency design index is a design index which is implemented for the existing vessels, which is named actually EEXI for existing vessels. So EEDI, yes, it refers to the design index of the new builds, and EEXI refers to the existing vessels. So while a new build after 2025 has to be phase EEDI phase 3, the existing vessels from the 1st of January 2023 have to implement another regulation which is called EEXI, so Energy Efficiency Existing Index. So, and this is, they have to reduce, all our vessels need to reduce the 20% by 20%, let's say the design emissions. So this is something that poses certain restrictions to the existing fleet, because the existing fleet has to put limiters on the engines. This means lower speed, and so assume that you have high consumption, you need to put to limit the speed substantially more compared to a younger vessel. So if you have, let's say, an old heavy consuming vessel, you will be in a position that you will not be able to use it with a speed, with a speed of, let's say, 12, 13 knots that the other vessels are going, and you need to slow down to, let's say,
slow it down. Yeah.
That would be a disadvantage.
And I think overall, with many people doing that, that's actually good for the market, reducing the supply of the tonnage.
Yes.
Let's move on. I just want to ask you about the intrinsic value. You recently, I guess a week ago, you had the earnings call for Q2. You talk about the creation of value, and you talk about scrubber technology. You have scrubbers, I believe, on 18 of the vessels. So I wonder if you could just walk us through how that works and how having the scrubbers creates shareholder value.
Hey, look, it's not only scrubbers. I would say 3 reasons how we have, let's say, this intrinsic value. First of all, it's the valuation of the new builds against the order of new builds. So when you buy something, let's say at 30, and right now it costs 40, so this represents a value for the shareholders at this stage. So this is the one point. The second point is the highest efficiency of the new build. So if you burn, let's say, 14 tons compared to 18 tons or 20 tons that the other vessels burn, you have higher earning capability, and this is not reflected in your, let's say, valuation. And the scrubbers, of course, is also an important role, because right now we have the so-called high five, the price differential between the heavy fuel oil and the low sulfur fuel oil that you need to burn when you don't have scrubber, which is about $400. And so if you assume that you burn, let's say, 20 tons per day, 20 tons per day times 400 right now is about
8,000, right?
1,000. So
yeah.
You see what is the price differential that you can make in certain occasions, compare when you have a vessel with scrubber fitted or when you don't have a scrubber. So it's substantially high. Even if you need to share something with your charter, assuming that you share some, let's say 10-20% of this amount, still you make substantially more money. So for an investment which is between 2.5 to 3 million, you have an excellent payback period. And we have done this investment, and we continue to invest in scrubbers, specifically in Capesizes, where the consumption is substantially higher.
Sure. So that's so the spread at this point is running around $400. As I recall, at the beginning of 2020, I guess the magic number, or the number people were talking about that was still going to be a very good payback. Correct me if I'm wrong. I think it was around 200.
Yes, it was 200, then it dropped to 100 at a certain point of time, even 75, 80, and right now with this crisis, it's about 400.
Just out of curiosity, what was the highest that I guess earlier this year? What was the highest that spread got to?
Look, this varies, but I think that this figure, this 400, is something which is substantially high. And if you assume that the vessel burns maybe about 7,000 tons per year, so if you make this multiplication, let's say 400, we have 400 this year on average, 400 times 7,000 makes a huge number against the investment, which is not that big.
And it reduces your payback period substantially. So let's shift gears, kind of. Let's talk about capital allocation. The company has a robust earnings generation capability, a lot of liquidity, and low debt compared to the scrap value. You're currently paying on the dividend. I think it's 5 cents a share, so it's roughly an annual yield of around 5%. Recently, you bought back shares of the common, I think 1 million shares, and you redeemed, you had preferred shares, you redeemed $37 million of those. So just looking forward, what is the strategy of the company as far as the capital allocation?
Yes, we have tried to have a meaningful dividend policy, which is this 5 cents per dollar, and we examine this policy every quarter based on the prevailing situation each time. The important thing for us is not to distribute all the money all the free cash flows to our shareholders, noting that our major shareholder, which is a Hadjiano family, Polish Hadjiano, our CEO, has about 40% of the company. Still, we don't want to distribute everything because we see the overall picture, and we want to have, let's say, the development and the future value of this company. So what we are doing is that we need to direct some portion of our free cash flows to our new buildings that we need to take delivery. We have deleveraged the company substantially. So basically, the leverage could be of the order of 30, 32, 33%, the overall leverage. We have stabilized the cost of our debt by issuing this earlier this year, this euro bond in the Athens Stock Exchange, about 100 million with 295, which is steady for 5 years. You understand that all these are advantages that we have. So our intention is, yes, we will continue based on the chartering conditions. We'll continue this dividend policy as is. We will continue the slow deleveraging. We have also, I need to remind you that we also did this redemption of Preferred.C, about 38 million US dollars were redeemed, and this is also benefit for dividend. This is also benefit for the common shareholders, because we took out this part which has 8% coupon, and we have started also the buyback program. So we do several things, thinking not this moment when we can, let's say, have a higher dividend, but we don't want to undermine the company and pay more dividend to our shareholders and increase the leverage after 1 or 2 years. We want to have substantial liquidity to be able, at any correction of the market, wherever it is, to do the right thing. Maybe we can buy another second hand. Maybe we can put another newbuild. Also, we are using biofuels. We want to examine the possibility of using alternative fuels. So we are very active on this front, and we are not behind. So we're checking methanol, we're checking ammonia, we're checking what should be the next one. So we have teams that are working on this front. So at a certain point of time, if there is a conclusion somewhere on which fuel will be used, we will be able to have substantial resources to invest and not to go to the markets and or to increase our leverage.
It's quite a balancing act, which you're navigating very successfully. So let's wrap it up. If you could, just to present at a high level the investment case, and just walk us through the key takeaways. Why the company is different from its peers. Why should somebody invest in safe bulkers?
Yes, first of all, the shareholders that invest in safe bulkers should know that they co-invest with our CEO, who is a major shareholder, who has 40%, and this gives the best reassurance that we will do the best that we can to secure the money and the wealth of all our shareholders, because we are partners, we are not managers. The second point is that the company will continue to be a vehicle of low leverage, so we need to maintain the leverage low, to have strong liquidity, because strong liquidity in good times is fine. In bad times, you can do things, you can buy things, you can order things. We're having an extensive program of new buildings, as we have already discussed, which will be delivered from now until then, having, let's say, about 25% of the fleet phase 3 and another 25% young fleets after 2013 with good characteristics. And we also invest in our existing fleet some money to upgrade their environmental performance. So the intention of our management is to compete, in the next 2 years, on the basis of operational and environmental performance, compared to the vast majority of the fleet out there, which will not be able to cope easily with the more stringent regulations will come up later on. After 25, after 2026, there will be further stringent regulations which will make the situation more difficult. Even in Europe, it will be difficult to come, or you need to pay a lot of money in terms of in relation to taxation. So we have all these things in mind, and I think it's Safe Bulkers is a good vehicle. We are trading, as we think, substantially lower than the net asset value of the stock, and so it's a good thesis to invest in Safe Bulkers.
Okay, well, a lot of factors to consider, and like I said, a lot of things to navigate. I guess from listening to you, I guess there's a lot of people talking about 2023, but you're looking beyond that, and you point out that the regulations are going to get tighter and tighter through the decade, and you're staying ahead of that. So that's great. We're gonna wrap it up. Thanks so much, Loucas, for coming on here. I enjoyed. I think on some of these topics you can go on for hours and hours. Unfortunately, we don't have enough time. But when I next see you, we'll get into some of the finer points of the EEDI and all the different phases. So thanks very much, everybody. Take care. It's Barry Parker from the Capital Link Trending News podcast series. Bye-bye.